The US dollar slides again, which nudges the Aussie dollar up again. How high can it go ahead of next week's decision by the Reserve Bank of Australia and tomorrow's key inflation data? And New Zealand's current account deficit improves a lot. That's coming up in our 5 Things in 5 Minutes on Tuesday, September the 23rd. And then in our deep dive interview, ANZ Head of FX Research Mahjabeen Zaman looks at whether the Aussie dollar is about to break above its decade-long range against the Kiwi of 100 to 115 Aussie cents to the Kiwi dollar.
The question from here is that what factors might prompt a breakout above its decade range high of 115?
But first, in 5 and 5 with ANZ, the US dollar index fell again overnight and has fallen 6.5% in the last 6 months, thanks to growing expectations of Fed rate cuts and underlying concern about confidence in the independence of the Fed and sharply higher US government bond issuance. That has seen the Aussie dollar rise solidly. Here's ANZ Head of FX Research, Mahjabeen Zaman, on how much higher the Aussie could go and what to watch for.
Our year-end forecast stands at 67 for the Aussie dollar, and a couple of drivers for that. The first being very aggressive Fed easing priced into the market as opposed to the RBA. We're only expecting one more rate cut in November, so that's helping the Aussie at the margin.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.3% and the Nasdaq up 0.7%. Fresh record highs after rises in the Magnificent Seven tech stocks. That's Nvidia, Apple, Tesla, Meta, Alphabet, Microsoft and Amazon. The 10-year US Treasury was flat at 4.14%. Gold rose another 2% to a fresh record high of $3,782 US an ounce. West Texas oil futures fell 0.3% to $62.22 US a barrel. The Aussie dollar up 0.1% at 65.99 US cents, and the Kiwi up 0.2% at 58.69 US cents. Number 2, Aussie dollar traders and the Reserve Bank of Australia will be watching tomorrow's monthly CPI indicator for August, with annual inflation expected by ANZ Research to rise to 3.3% from 2.8%. ANZ senior rate strategist Jack Chambers says he'll be watching building costs in particular, which have risen recently.
Maybe builders rebuilding sort of their margins on selling properties as the housing market has sort of re-accelerated in the last few months. If we get an outcome where people start forecasting that Australia or the RBA's preferred core inflation measure of trim mean inflation, if that's looking like a 0.7 or a 0.8 Q on Q in Q3, that will start supporting our view that the RBA probably only has one more cut in November.
Number 3, the Governor of the Reserve Bank of Australia, Michelle Bullock, gave a speech yesterday ahead of next week's cash rate decision. ANZ's head of Australian economics, Adam Boyton, says she gave a couple of very mild hints suggesting a hold, including that she's happy with inflation progress, but sees the labour market remaining tight.
If you take all of those tea leaves and give them a good stir, you're probably left with a marginally more hawkish brew than perhaps we had in August. Nothing, I think, that would cause people to change their views about the monetary policy outlook, but also potentially a form of words that does say the bank's unlikely to go next week, but will instead wait for the full quarterly CPI, the updated forecast from the staff, and come back and have a serious consideration in November, where we do think they will cut by 25 basis points.
Number 4, from New Zealand, ANZ Chief Economist Sharon Zollner has spotted some good news in the national accounts on the current account deficit. And that's the trade deficit plus the deficit from overseas dividends and interest costs on asset and debt. Here's Sharon.
Stats New Zealand has revised down the value of imports, looking at the likes of Temu parcels, weren't of a higher average value as they'd been assuming. Also revised up their estimates of the returns that New Zealanders have been getting on their investment overseas. Both of those things, plus a recession, of course, which means low imports, has seen the current account deficit shrink down to 3.7% of GDP, far better than it was at its peak in 2022. It hit 9.5% of GDP.
Number 5, the People's Bank of China held its key loan prime rate, or LPR, steady yesterday, as expected. A rate cut isn't needed yet, says ANZ senior China strategist Zhao Pengxing.
The biggest reason for no change is the slowdown of growth momentum remain insufficient for an interest rate cut. In order to achieve 5% GDP growth this year, China only needs 4.6% growth in the second half of the year. So the monthly growth haven't touched the bottom line. We maintain the call for 10 bips interest rate cut in Q4 because we see further downside risk to GDP growth, which may fall below 4.6%.
Zhao Pengxing there. Now, in our deep dive interview, I spoke to ANZ Head of FX Research, Mahjabeen Zaman, about the Aussie-Kiwi cross rate, which rose above 112 Aussie cents per Kiwi dollar last week. That's near a 3-year high and near the top of its trading band for the last decade of 100 to 115 Aussie cents to the Kiwi dollar.
The question from here is that what factors might prompt a breakout above its decade range high of about 115? So we actually did some work. We examined 3 different points in history, including the time where the pair surpassed levels of 135 in 2011.
And what did you find when you looked at these 3 different periods?
Looking at the first era, we broke it down to Australia's mining boom, which was roughly, 2001 or 2 up to maybe 2012 or so. And, it was interesting to see that that was the time where China implemented reforms to support its property sector. And of course, that drove demand for resources here in Australia. So mining exports picked up. And, it's interesting to see that the positive correlation between the Aussie dollar and China's fixed investment in the property sector were pretty key at that stage. Now, at that point, New Zealand, on the contrary, also had a pretty good relationship with China, but the differential or the size of that relationship was much smaller than Australia's size. So we did some work and we saw that the terms of trade really explained most of the moves in this pair. And that's when we saw the Aussie Kiwi touch a high of 135 and above it back in 2011.
And then there's a period at the end of the mining boom from 2012 to 2015. What did you find there?
Yes, towards that time, of course, iron ore prices fell much more than dairy prices. So, the Australian relative terms of trade to New Zealand fell. Another factor also that mattered for this pair was that monetary policy. The RBA was cutting during that period, 2012 to 2015, while the RBNZ had held rates pretty steady from 2012 to 2014, and in fact raised them in 2015. And, rate differentials are a key driver of this pair. And so this saw the turn lower in the pair.
And then we've got that final period from 2015 onwards when it's been in this 1 to 115 range. What's the driving features there?
Yeah, I think what we have seen be the key driver of the Aussie Kiwi in this new era, let's say the past decade or so, has been really, again, terms of trade, inflation differentials between the two economies. Now, the question that we do get asked is, given the Aussie Kiwi pair has moved up so much higher, what's really going to drive it beyond this 10-year range or so? And I think that will be really either we see a divergence in policy rates between the RBA and RBNZ, as we saw in 2014 and 2015. But, that's a story for 2026 in terms of rate hikes or how long they're going to be on hold. And then the other point could be, Australia's terms of trade would need to outperform New Zealand's by a wide margin. Again, that's quite unlikely given the consistent decline in mining investment here in Australia as a percentage of GDP. So it's hard to see new territories for this currency pair in the near term.
You've looked at one particular relationship, the Australian iron ore price versus the New Zealand dairy price, as a proxy for export returns. And what have you found there in terms of correlation?
Yeah, that correlation has been pretty strong and has driven the Aussie Kiwi for quite some period. But in the recent years, though, again, the iron ore price to milk ratio has been trending downwards, again, because of the slowing mining sector, or, it's not what it used to be back in the years ago, while dairy prices have actually held up. So I think this dynamic will kind of determine the direction of the Aussie Kiwi, but more so it would be the rate differentials in the short term.
So the Aussie now over that 112 mark. Why is 115 seen as important?
So when we go back to the last 10 years or so, 2022 was when we saw the Aussie Kiwi touch a high close to 115. And that's kind of in our mind, a key level, because that's been more the 10-year high. Breaching that would then again test a new territory for the pair. I think it's unlikely.
Mahjabeen Zaman there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, September the 23rd. Catch you tomorrow with the latest on Australian consumer confidence. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.